Hey everyone, this is Ryan Mallory for SharePlanner.com doing another Google Hangout on this November 19th day. If you're in Florida like I am, then you experienced some pretty harsh weather today. I mean, it got down into the high 40s and enough to warrant putting on, something besides shorts today. I had to put on some sweatpants, and needless to say, it was cold. But let not your heart be troubled. It's back in the high 60s right now, so it can go on like normal right now. So yeah, in fact, it's supposed to be back in the 80s, but that's it doesn't. You don't really get the seasons, man, like you would really like to in Florida, but that's okay. So we'll get onto trading here. I get off of the weather kick here. Sometimes it's an easy segue into trading to talk about that. All right, so the S&P 500, we got some weakness today. I'm a little bit concerned, at least more so early on, by the weakness that we were getting, because a lot of times when we've had a really long and extended rally, particularly like what we really so much like what we had in early or mid-October, and then the 200-point rally that ensued, and then we've been like consolidating, going on 2 weeks now. We haven't quite hit the 2-week mark yet, but yesterday ended that consolidation and we broke out to new all-time highs. So that's always a really encouraging sign. But what's not encouraging is when the following day we cannot, and remember, this is coming on the heels of an extended period of consolidation. So some of that, consolidation helps work off the overbought conditions, even though on the stochastics we're still like well over 80. It does help, slow down the euphoria, let the market catch its breath some. But then when you break out and the next day you give it all back, that's not a good sign. Now, we have still about 3 hours of trading, and within that 3 hours of trading, you still have the FOMC minutes that will be coming out. And that can definitely shake up the market, and I'll get to that in a second. But we have seen a bounce off of the lows of the day, and off of those lows of the day, you've seen a hammer candle, long candle shadow, and trying to make a pushback towards yesterday's closing highs, closing all-time highs. Other thing to note is you have the 5-day and the 10-day moving average converging together. So both the 5-day and the 10 days being tested on a regular basis. And you could see here, going back to the 13th of last week, we tested the 10-day, we popped, we tested again this week on Monday, and we popped, and we tested it again today, and we popped higher. So whether we go green or not, I'm not sure, but that 10-day moving average is starting to provide a decent amount of support for the dip buyers to get behind this market rally. Now, the bigger thing that's looming, and in about 50 minutes, the FOMC minutes will be coming out. And so, a lot of times in the past, the FOMC minutes was not that big of a deal. Nobody really paid too much attention to it because, anything that was said was already in the FOMC statement. But now it's starting to take on a lot more importance than it did in the past. In fact, the biggest reaction from anything the FOMC statement has released in recent months, or I'd say probably this entire year, has come from the FOMC minutes. Now, take yourself back to October 8th. Okay, we were in a pretty heavy for the market. So I'll look at it from the daily first. This is what the FOMC minutes did on October 8th. You can tell at one point, first of all, we were already in a pretty good downtrend. Okay, things were starting to look pretty negative. Before the FOMC minutes were reported, there was a nasty shadow or we were actually trading below the previous day's lows. And then the FOMC statement came out, and it was a huge rally. Now, let's look at it from the 30-day chart. And this sort of takes a little bit of setting up to get, because I got to scroll way back on the 30 minutes here. All right. Yeah, that's not 30. That's 15. There we go. Here. Okay. So this is your 30-minute chart from the 8th. We were going down, 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 and then around 11:30 we started seeing a little bit of a pop. But from the previous day's close, we were right at break even when that FOMC statement came out at 2 p.m. And look at what it did. At 2 p.m. it goes from 1936 all the way up to, let's see what the highs of the day were, 1970. Okay, again, it goes from 1937 at 2 p.m. all the way up to the highs of the day being 1970. So that is a huge route. That's 33 points after the FOMC minutes come, which is a summary of basically like what the FOMC statement had to say a couple of weeks prior. So you wouldn't think that there would be so much weighing on the FOMC minutes, but that's the character it has taken on now. So fast forward back today, obviously we're not in a downtrend by any means, but we sold off early on like we did on the FOMC minute from that previous day, and then we bounced back up, heading into the FOMC minutes. Now, whether or not we take on like some massive 30-point rally, I don't ever expect 30-point rallies off of any news piece. It happens, but that's not my default expectation. So I always expect a little bit something milder than that, but it can happen, and you got to be able to prepare yourself. Now, what have I been doing leading into today's FOMC minutes? Absolutely nothing. I haven't done nothing to the portfolio. I haven't taken anything out, and I haven't even added anything to the portfolio. We'll let the FOMC minutes play itself out, and maybe this afternoon, if the trade setups are right and they're there, then we'll take something in the splash zone. But until then, I'm not going to touch this market. I'm just going to let our portfolio stay where it's at. It's in good shape right now. Right now, I'm holding on to 6 stocks. 5 of them are winners, and 1 of them is a loser right now. Actually, going in today, all 6 of them were winners. But thanks to Morgan Stanley, Tesla had a little bit of a shakeout there, so the profits in that deteriorated pretty quickly at the open. So Tesla is something that you have to be really patient with, and really put those stop losses at a good place. Because if you look at our Tesla trade so far today, we got like within 10 cents of being stopped out on this thing. But overall, in the 30-minute, it looks like it's trying to recover. Since that 12:30 bounce, it's been a bull flagging a little bit intraday. So it's probably going to need the FOMC minutes to have a positive reaction to really get anything back out of this stock today. Let's look at a few other positions that we have. HUN is our best stock in the portfolio right now. We'll look at it from the daily chart. It was actually getting hammered pretty good earlier today, but the reason why I never closed it out is because the trade wasn't being compromised. The trade setup was still very healthy. The chart was still very healthy, still trading above the 5-day moving average, which it's done a great job of in the past. So it's easy to want to panic when you're seeing like a 2% move to the downside, or 1.5% to the downside, or even just like a 1% to the downside. But you can't do that if you don't. Because what happens is you see 2%, you start thinking, okay, I'm losing a couple $100 off of what I had when I came into today, and I can't afford to lose anything else. That's a lot of money. And really, when you're trading, you should already be willing to lose the money up to that stop loss that you're setting in place. So if that stop loss hasn't been put in place, you shouldn't be, or if that stop loss that you've put in place hasn't been hit yet, you shouldn't be panicking about your trade. You should be letting the chart guide you, not your emotions. And what drives the emotions in the stock market is your money. And if you start trading based off of dollars in the portfolio, that's where you get yourself in trouble, because you start personalizing the profits. If you're up $1,000, you start thinking, well, I can make a mortgage payment with that. I can pay my taxes with that. I can pay, Susie Q's college education with that. Well, for like 5 days, you can pay for her college education with that. But you can't do that. You can't let what you'd like to do with that money, or what would, how crappy it would be if you lost some of the profits. You can't let that drive your emotions on the trade. So HUN, yeah, we were down a little bit. It's actually recovered quite a bit. I think it was all the way down to below 25.90 at one point today, and it has come back quite nicely. Another good example of that is UA. And UA, holy cow, this stock has been a little bit of a roller coaster the last 3 days. I mean, you can see here, and let me pull up the 5 minute on this joker. Okay, that is not it. That's the 3 day. There we go. Okay, you can see some of these topsy-turvy moves here intraday on the 5 minute chart. It pulls way off and then it rallies right back up. That was yesterday. Did a little bit of that as well on the 17th, rallies into the close. And then again today, sold off, and man, it was looking like crap. In fact, if you look at the 5 minute chart, it was starting to break key level support. And then lo and behold, it goes from $68.50 up to $70.10. It's the second best stock in the portfolio today. And then if you look at the daily chart, it's looking really good. I mean, this thing looks like it wants to, maybe push up to 73 now. There's really not a lot of resistance in the way of it, and it looks really, really nice to the eye. And that's the thing. That's why a lot of times, unless there's just a red line being crossed, that I'm not going to probably get out of a stock intraday unless there's a place, okay, where I say, that's it. If it crosses it, I don't care if it bounces back later in the day or not. I'm not going to risk it. I'm going to get out at that point because there's a technical barrier being breached that shouldn't have been breached. Now, that didn't none of the previous 3 days, including today, has that happened with UA. So I never got out of it. It got close. It got very close, especially got close today. But each time it bounced back. And so you got to sometimes give these stocks a full day of trading to really see, okay, should I be getting out at the close or not? And if so, that decision will be a lot more clear to you towards the end of the day when you have to decide, okay, am I willing to hold this another night, overnight, where news can impact it? Some stupid analyst can come out and say, hey, I don't like UA, and it drops 5% or whatever. So you got to ask yourself, do I like the overnight risk? Do I like the way that this chart is going to close on the day? Usually around 3:45, I can get a good feel for that. And and each time UA has stuck around. At the end of the day, the charts have improved, and the early bearishness has turned into afternoon bullishness. So I said, we talked about the S&P here. The other thing too, and I'm going to go back a little bit to the S&P, and I'm not going to dig back into any previous Fed statements or FOMC statements or minutes like I did previously. But what I want to talk about though is how the market tends to react to the FOMC statement, the Fed minutes, and that is usually where there's like a move, a counter move, and then the ultimate move. So a lot of times that first move is usually the right direction, but you can't. Sometimes it's not though, okay? But what I'm trying to say is you can't make a decision based off of that first move or the second move that the Fed moves, or that the index makes after the minutes or the statement is released. You have to give it a little bit of time, preferably at least 15 to 30 minutes. 15 is really pushing it and puts you in a position to get stuck in a bad trade. 30 minutes, usually at that point, you're getting a better feel for how the market wants to respond to it. Now, yes, that does mean that the market could be rallying well beyond the pre-Fed minutes or the statement. And if that happens, you just have to, tip your hat and say, okay, I'll still try to find a trade setup that hasn't really run yet with the market, but provides a great risk reward. But you don't want to chase it if the market does just, shoot right out of the hatch and does really good. You don't want to chase. So a lot of times, and one of the things that's been really popular to live of this week has been, gosh, I feel like I'm stumbling all over my words talking to you guys, so my apologies for that. But one of the ETFs, sectors, industries, whatever you want to call it, the junior gold miners, okay? So you have JNUG. I mean, look at the volume in this thing in the last few days. This to me is really crazy that people want to play this kind of a stock. I mean, there's 27 million shares being traded at $5.63. There's plenty of liquidity. That's not the issue. The problem is the intraday price movements, the overnight risk. It's not worth it. So what draws somebody to JNUG? It's trending on StockTwits right now. You know, and a lot of gold miners are trending on stock twits, but particularly with the junior miners. Why do people want to go after these 3x ETFs where there's no risk reward whatsoever? And I'm not saying that there's never a reason to trade a 3x ETF. I've done it. I did it last month when the market was, you know, falling hard. It's difficult. I'm not going to lie to you, but in this particular situation where junior miners are extremely volatile, as it already is, why would you want to go do 3 times that? Well, I could tell you why people trade it is because they see the profit potential. But when they see the profit potential, they completely ignore the risk potential to that trade as well. They just see, well, man, if I can look at what it's already done today, it's gone all the way down to $5. It's gone all back up to $5.53. That's a 10% move. Man, if I could hold on to it for a couple of nights, this thing could be trading at $10 in like a week or so, and I could be making a lot of money. That's what people were thinking. They're thinking, okay, I could put $10,000 on it, and next week it could be worth $20,000. And it could. It very well could. But on the same note, okay, this stock has the potential over the next few days, especially with the FOMC or the Fed minutes coming out here in just a little bit, it has the potential to be right back down to $4. And guess what? You just lost 20%. But that doesn't resonate with a lot of traders because it's not sexy to think about the risk. What's sexy is to think about, oh man, I could get some serious cash off of this JNUG. I'll just hold it. I'll ignore the movements until it just works out in my favor. Well, newsflash, the 3x ETFs, the longer you hold them, the less likely it's going to work out in your favor. And it's tempting. Trust me, it's tempting to me. Okay, I look at these things and I say, okay, is there a risk reward that's favorable to me? No, not at all. Okay, it just isn't. Because first of all, I've been doing this long enough to know that there's no way even if I traded it and I threw risk out the window, there's no way I could trade it and hold it up to 10, just not within my personality. Okay, I get up to 750, I've made 50%. There's no way that I would be risking that overnight. I get up to 6. There's no way I'm probably going to be risking 20% overnight in those gains, okay? Especially with it being a 3x where you have time decay and the large majority of people who trade them are going to lose. This volume here, this volume going back to late October and up until today, I mean, you got 20 million shares being traded regularly. All that represents is there's a lot of people that are getting ready to get smoked on JNUG, okay? But if you want to trade the gold miners, if you are just that, and I don't blame you for wanting to trade them and everything, but find something that has a little bit better risk reward. Now, GDX, I'm not saying that the risk reward is there, but it is better than what you're going to get out of JNUG. So if you wanted to trade it, I don't even like the setup, but let's just, you know, say that we have to trade GDX, okay? Well, you have a much better chance at having a favorable risk reward if you put, say, your stop below 19, below the lows of the day. That means it has to get below yesterday's lows again, and then get below the lows of today as well. And so I would put it like at 1921. My little virtual calculator out here and tell you what the risk is. But then your risk is about 3.2%. That's very much more, that's very acceptable to risk 3% on a trade rather than 10 or 20% on a trade, because you're going to probably lose on JNUG because it's not so much the stock itself, it's what it does to your emotions. And if it's going to crank up those emotions, you're going to make some bad decisions, okay? I trade in such a way to make my emotions irrelevant, to where they don't bother me, to where they don't harass me during the day. But if you start throwing yourself into JNUG and some of these other guys, I'm telling you, you're going to live to regret it, because this is the kind of stock that can ruin an entire year's worth of work of consistently profiting. So if you want to jump in there, that's great. I would personally rather go to Las Vegas and enjoy the, well, they don't really give you free stuff anymore unless you're really high rolling. But, you know, I would rather go to Las Vegas and throw my money away there rather than trying to play it with JNUG, because it just doesn't work out like most people expect it to. Speaking of some of these commodities, let's look at USO. This thing is really amazing. I mean, it is just not bouncing. Now, there's a little bit of a signs of life today, but I wouldn't call that really a bounce at all. It's up 1%. Woohoo! Okay, but I mean, this thing has just been a disaster since July, going from 39 down to 28, and it still isn't up above the 5-day moving average. It got up above there for a little bit today, but it didn't hang around there for very long. It's just still sitting right below it. Eventually, oil is going to bounce. The problem is like it looked like it was going to bounce around 31. And in fact, I took a short-term trade in USO, and I quickly got out after it was becoming obvious that it wasn't going to bounce. Now, and look what it's done since then. It's gone from 30 down to 28. So there's been a lot more price erosion on this thing. So yes, it looks like that it could be forming a short-term base here. It's nothing near the base that was forming here back in late October, and then ultimately failed again. But it is somewhat of a base. It's trying to hold those lows from the 13th. But now you can play it, but if it makes new lows off of this downtrend, then you need to get back out of it again. There's a lot of oil plays setting up. It's not. I definitely don't recommend trading how there's a lot of news events that hasn't really helped it out as much as you would like it to, and then. But if you take something like COG, I mean, look at this. It's breaking above the 200-day moving average. It's breaking out of this base here. You can probably get long on it at around 34.39, and you could put your stop loss below. I don't know. You could probably put it like 33.8, and you have a pretty good, decent reward, because if this thing continues to pop, and it's already up 3% today, so it's kind of getting away from us. But if it continues to run, I mean, it could easily hit 36.85 in the next week or two, and the perfect ideal scenario would be like $39 or so, or a test of the May highs. Question was asked in the splash zone about this stock here, HBI, and it doesn't look bad actually. I mean, it's coming out of a base. It looks pretty good. I will pass on it just simply because I've got Under Armour in the portfolio, and that's enough apparel, clothing stocks, for one portfolio. That thing has been, a little bit of a roller coaster, so I don't want to add to it by adding another. Coming down, HBI, Hanesbrand, it's going to be a little bit less volatile than UA, but nonetheless, the trade setup looks really good. So if you get in at like the current price, it's a little bit beyond where I would think the ideal entry would be on this. I'd say if you could get in. If you could have got in probably like around 110.58, that would have been good. So it's about 1% removed from it. But you can get in and you can put your stop loss below 108.50. And you got a pretty good risk reward. I mean, you got less than 3% on the risk side. And there's a lot of potential to this. I mean, just look at the rally this thing has been on. So it's a good safe play. And we got into BA yesterday, and it's a similar stock that tends to do really well. It's consolidated for most of 2014, but it's finally coming back out. But in the years prior to it, I mean, it was unbelievable. So, well, stocks like this, especially when the market is consolidating at the highs of late, and it just isn't really like what we've seen over the last 6 days, a lot of your momentum plays are going to get slaughtered. So you want any momentum plays you have in a portfolio, it's good to offset it with a stock like HBI or BA or, I mean, people have been nailing McDonald's of late, but man, that chart is really starting to come along nicely. And I would like to see some consolidation on MCD, but if it can consolidate between 96 and 97 and then break out above 97, that would be a really good trade setup there with a low level of risk. So, all right, I've kind of gone off track, but a couple of more stocks I want to look at because they've been talked about quite a bit. BABA, it's bounced off of the 20-day moving average. I think this is where the dip buyers are trying to come in and see if they can push it back up to 120. A lot of them are probably excited that they're getting them, on the shares on the cheap. You can trade it and see where I'm not opposed to you trying this thing off the 20-day moving average. It does look very appealing. However, I think that you have a heightened chance of losing on this particular trade. I think this could be sort of like a sucker's rally, trying to get all the dip buyers in, and then it's just going to push it down further. Anytime you go from like $80 to $120 on a stock that's like bigger than Walmart, I think you got to allow for a little bit more retraction than just, less than a 10% correction. So don't be surprised at BABA if that's a sucker's rally and it goes back down to like $100 or so, because you do have a little bit of support here on BABA at $100. Once again, if you want to try it, the risk reward isn't all that bad, and if you're right, you're probably going to make, a 3-to-1 reward to risk return, and yeah, there's nothing wrong with that at all. But my initial thought is it's probably a sucker's rally, but I have no way of proving that. So, and the last one, GPRO. There's no way to really manage the risk as well as I'd like. It opened up higher today. It looked like it was going to confirm that head and shoulders pattern on the daily chart, and it just gave back the gains. So that's the problem with trading a stock like GPRO, where there's just so much volatility to it. Now, what looked really good in the morning now looks like a bearish and engulfing candle pattern, where today's candle body completely engulfs the previous day's candle body. And so I would be a little bit concerned about this, but if it can consolidate right around here in the next few days, there could be a trade opportunity in GPRO, and I could be tempted to take it if it consolidates just right, because that is a textbook inverse head and shoulders pattern. This being the left shoulder, the head, followed by the right shoulder. That looks really good and something that's very tempting to trade. So that's going to do it for now. I'll be in the splash zone the rest of the day. If you haven't tried this splash zone out yet, I'd highly recommend that you sign up for a free 7-day trial. You can cancel it at any time at no cost. And with it, you get access to the chat room. There's some awesome traders in there. And I'm learning from everybody in there every day. It's been great for me. And I feel privileged to be able to lead that group. Now, there's also text alerts, email alerts. It's available for anybody internationally as well. So it's you get the whole shebang. It's great. So if you want to try it, go to shareplanner.com/splash zone, and you'll get all the information there, and you can subscribe there as well. We all take care. I'll probably do another hangout on Friday. So until then, God bless you all and have a great day.